Good day, all Inderes TV viewers. Nordea published its fourth quarter results. Today I'm interviewing Group CFO Ian Smith today. Ian, another record year with return on equity over 15%. How would you summarize the full year and the fourth quarter?
Sure. Hi, Venry. Good to see you again. I think we finished the year strongly, and 2024 was another good year for Nordea, as you say. The second year in a row that we achieved a return on equity above 16%. So a strong year in difficult circumstances. I don't need to remind you that the world has had some unexpected events during 2024, and that impacts all of us. We continue to see good performance across all of our businesses. Markets are a little bit quieter for lending, and I'm sure we'll talk about that. But generally speaking, very pleased, and we delivered on our targets. We met the market's expectations. So I think a good day for Nordea.
So you're satisfied?
Yes.
Well, you already mentioned loan volumes. Everyone knows that deposit margins are decreasing across Europe, and you can counterbalance that by increasing your loan volumes. So how do you see the loan volume growth going forward?
So we grew our loan volumes in Q4 in both mortgages and corporate by around 1% each. And that's in quiet markets. So it's good that we do see some growth. On the mortgage side, that is principally in Sweden and Norway. And on the corporate side, it's in all of our markets. I guess one of the things that we see changing is interest rates. And as interest rates start to or continue to come down, we think that will feed through into greater consumer confidence and allow consumers to go out and start spending and investing more than they have in the last couple of years. That should help with growth in markets in general, in lending markets. But I think perhaps towards the second half of the year. So I think things should be rather stable for the first half, perhaps with some growth coming back at the end of the year as consumer confidence starts to increase. And as you say, that's helpful to offset the negative impact of rate cuts. And I think Nordea is in a good position to balance both being ready for growth, but also to manage the impact of rate cuts. We have, as I know some people will be familiar with, different to some of our Nordic peers, we have a hedge in place on deposits that helps to reduce the impact of rate cuts as they come down, and that'll be supportive for us next year.
You said that you expect that low volumes should pick up in the latter half of the year, but is there any concrete evidence? Because that has been waited for some time now, and even though real income growth is positive in the many Nordic countries right now, but still it seems the consumer is quite careful.
Yeah, the consumer is pretty careful at the moment, and you can understand why. In Denmark, for example, we've seen food price inflation of 25%. So, the consumers have had a tough time of it. And when you see the pressure on household budgets that comes from inflation, interest rates, and the uncertainty in the world, it's going to make people cautious. And you see that caution come through in that our deposit volumes are increasing. So people are holding on to their liquidity. I think when we start to see people be more confident that lower rates are here to stay, and they feel confident that they still have jobs, and one of the things that I think has been really helpful is employment has held up really well. That should help stimulate additional confidence and help people feel better about spending and investing. So.
Exactly. Nordea guided that its return on equity will achieve the target of 50, or it will be over 15% this year as well, which will be third year of this level. So what are the main drivers behind this target, and how should you achieve that?
Well, I think that the first point to note is that our return on equity for 2024 was 16.7%. So already at a very high level. And we're guiding that we'll meet our target of more than 15% next year. So I think we start from a good place. And for us, it's about managing all of the things that we've proved ourselves good at managing up until now. So first of all, driving income growth. That's tough in a market where we'll see lower rates and therefore lower net interest income. But we've seen encouraging growth in our fee income. So that's up 8% year on year. And I think that's a very helpful development to support the income side of things. And we need to be very disciplined around costs. Our costs increased in 2024 because we invested heavily in technology, in risk management, and in areas of growth. And so we've got to keep a very tight rein on costs also to help deliver on our targets. And then finally, an important element is loan losses. And we've seen very low loan losses in 2024, despite some of the headwinds and difficult conditions out there. And that says that we've got a customer base that's in reasonably good shape and a well-constructed loan portfolio. So I think all of those three things together will help us deliver on our target of ROE above 15% this year.
A few follow-up questions. Firstly, I just want to ask that the loan loss ratio is constantly well under your, I think it was 10 basis points, but it should be average over time. So have you been surprised when you see those so low loan losses all the time?
I think it's been really encouraging, and loan losses have been lower than most people have expected. We hold strong provisions and buffers to be able to deal with loan losses, and we still have those provisions and buffers intact. I think it says that, first of all, we have managed the portfolio well in terms of the diversification, but also just the fundamental credit discipline, I think has been there. And it also shows that, despite some of the economic turmoil, customers and societies across the Nordics have come through this in good shape. So,
as you said, year 24 was a year of heavy investments and on the other hand, some cost inflation. But how do you see your cost level going up in the next few years?
So we guided today that our total costs in 2025 will be around 2 to 2.5% higher than this year. And that's because we've scaled up our level of investment in 2024, and we're going to maintain that. So we don't expect to see investments increase. And having had very strong inflation over the last couple of years, we've seen that ease off a little bit. And when you add that together with our reputation for being able to deliver efficiencies, I'm confident that our cost growth will be as guided today. It's important for people who follow these things. Quarter on quarter, this year our costs will be reasonably even. So we'll see perhaps a little higher annual cost growth in the first two quarters and then much lower in the second. But broadly speaking, we'll deliver much more modest cost growth in 2025.
Well over 5 years ago, before the present management took over, Nordea was a laggard compared to Nordic peers when it comes to return on equity and efficiency and so on. But now Nordea is clearly the star in the Nordic banking sector, if one could say so. Nordea also has quite big asset management business, which is capital light and has a lot higher return on equity than the traditional banking business. So I have a few questions. Do you see that the traditional banking business of Nordea can achieve return on equity over 50%, which it has done in the past few years? But is that sustainable level? And does your very good return on equity, can it be explained by your quite big asset management business compared to your, let's say, Nordic peers?
So Nordea's ambition is to provide a broad range of financial services to customers across the region. And so if we think of that as traditional banking, and I know what you mean, Verni, you're talking about lending business, but for us, traditional banking is to provide for all of those needs, all of the financial needs of our customers. It might be lending to buy a home. It might be helping with advice on savings and investment. It might be helping them using their credit card for foreign payments, all of those kinds of things. So We see that it's just our asset management business is an important part of what we offer, but it sits as a very natural. It has a natural place in traditional banking, if you like. When we talk to customers, we talk to them about saving for the future, and they can save for the future by looking at our deposit products or our investment products, pensions, all those kinds of things. And central to that is a really well-performing, large-scale asset management capability. So I see that right in the center of traditional banking. So it's an important part of what we do. And interestingly, you talked a little bit before about how we deal with net interest income coming down because of rates. At the same time, we see our fee income, and half of that fee income is in savings and asset management. That's starting to increase. So a nice balance.
Indeed. Do you see that the traditional banking is it's feeding like assets to the asset management side, if you could say so?
I think a good example is the success we've had in private banking, where we've grown substantially. And private banking customers, generally speaking, will have their daily banking needs with us. We hopefully are the main bank for their business, and we also then provide opportunities for them to invest their wealth. And so, yes, our core customer base feeds all of our different businesses, including asset management.
I think Nordea has well over 400 billion euros assets under management. But in the last few years, I think most of the growth has come through positive returns, even though I think fourth quarter you had very strong sales in the asset management business. But how do you see going forward? That should we expect stronger sales in asset management going forward, or should the AUM growth be a result of positive returns on investments?
So Q4, you're right. Q4 was a really positive quarter for sales, and in fact, of the growth in assets under management, most of that came from attracting net flows into our business, so new money from our customers. And in previous quarters, we've seen a stronger contribution from market performance and other things. It's always a balance. I mean, part of market performance comes from the skill with which we invest our customers' money. So being able to have strongly performing products, etc. So it's always going to be a balance. But the thing we look at closely is, are we bringing in new funds with our customers? That receives intense attention rather than relying on markets to help lift the level. And Q4 was really good for us.
Will Q4 be an exception, or is it the new norm?
I think that there are a couple of elements in Q4 that won't repeat. So, for example, we saw more than 2 billion euros of assets under management come in from our acquisition, the customers that came with our acquisition in Norway. Obviously, that's not something that happens every quarter. But we expect our life and pensions business, our private banking business, and our core retail fund investments to attract good inflows each quarter.
Then lastly, question I think many viewers will be very interested on about the dividend and profit distribution. You hiked your dividend a bit, but you're still also continuing to use the other tool that you're buying back Nordea shares. But how do you see the capital distribution going forward? That you still want to buy a lot of back Nordea shares despite where the share goes in the market?
So we know that dividends are really important to our shareholders, and we're one of the biggest dividend payers in the Nordics. I think for 2024 we'll pay out almost 3.3 billion in dividends, and our dividend per share is up 2% at 94 euro cents per share this year. And that's important. We want to show regular progression in our dividend per share. We think that's really important. So first and foremost, that is our main means of returning capital to shareholders. We think that buybacks have a part to play. We have a buyback program that's going on at the moment, and it continues until the end of February. And as we said today, We're already in close dialogue with the ECB about the next program. So it's always going to be part of the mix. But we've said that what you can expect from Nordea going forward is, I think we use the term sort of, little and often. So smaller, regular buyback programs, which I think are a useful supplementary tool alongside the dividend, which is most important to us.
Should we think that you aim to keep the dividend stable and grow it every year, but the buybacks could vary between years if sometimes you will have a bad year in the future?
I think it's not about good or bad years. It's about the extent to which we have more capital than we need. So we want to keep a steady progression in our dividend per share. I think that's a really good measure of how Nordea continues to make progress. So that'll be the central aim. And as I said, we grew our dividend per share from 92 cents last year to 94 cents for 2024. And we want to keep working at that. And then if we find Nordea generates strong capital each quarter, and there's a few things you can do with that. You can invest it in your business. You can use it to drive growth, either by lending more or through acquisition. But if you can't find good, profitable opportunities for that capital, it makes sense then to give it to shareholders. And we do that primarily through buybacks. If we found ourselves in a different position in the future, we would think differently. It doesn't change the way we think about our dividend.
Exactly. Thanks for the interview, and I wish you best for this year.
Thank you, Verneri. Really good to see you again.